This lesson is about retirement of a partner from a partnership business. At the end of the lesson, I will illustrate the content of the lesson using a fully worked example. The outline of the lesson will therefore be accounting entries on retirement of a partner, valuation of goodwill on retirement of a partner, and finally, worked example. Let us start looking at the various concepts that we shall be considering in this particular lesson. A partner may retire from partnership either voluntarily by selling his or her equity in the partnership, or a partner may retire involuntarily, and this is by reaching the mandatory age in case the partnership has a mandatory age at which a partner needs to leave the partnership, or by death. In that case of retirement of a partner, the partnership is considered to be dissolved. So upon retirement of partner, a partnership is considered to be dissolved. And then if the remaining partners are willing to continue with the partnership, then they have or they are purchasing the equity of the retiring partner using their personal assets. This can be done in the following ways: determining the net income or loss for the year in which the partner retires up to the date of that particular year, closing the books of the partnership, and finally preparing the financial statements. These financial statements are meant to show the profit which has been made by the partnership in the year of income in which the partner is retiring. This is a situation where the retirement may take place within the year before the end of the accounting year. Payment to a retiring partner can be made in two ways. One is from the partner's personal assets, that is for the remaining partners. It can also be made from the assets of the partnership. To begin with, when payments are made from the personal assets of the remaining partners, this is like a direct opposite of when a new partner is admitted to purchase the interest of the retiring partner. In some partnership situation, when a partner retires, a new partner may be admitted and the new partner purchases all that belong to the retiring partner. So it is like exchange of assets for the new capital. Also, in case of payment of the retiring partner by the personal assets of the remaining partners, it is a personal transaction between the partners. In other words, the partnership is not as involved, but the partners among themselves. When a partnership assets are used to settle a retiring partner, what happens is that both the total assets of the partner in the partnership and the capital of the partnership decreases because the retiring partner withdraws their own assets, which are part of the financing of the partnership business. The following adjustments are therefore required in a case a partner is retiring from a partnership business. First is determination of the new profit sharing ratio or gaining ratio between the remaining partners. Then treatment of goodwill need to be outlined, and this involves valuation of goodwill and then how that goodwill is shared among the remaining partners in the new profit sharing ratio. The valuation of assets and liabilities may also take place, but in this lecture, mainly we'll focus on treatment of goodwill when a partner retires. There will be a lesson later on the valuation of assets and liabilities, and that will be covering retirement of a partner, admission of a partner, and also change in profit sharing ratio, because these are the major changes which significantly affect the partnership agreement. Next is that the current account of the remaining partners is transferred to the partner's capital account. The retiring partner, the retiring partner's current account balance need to be transferred by balancing of the current account balance and the amount being transferred to the capital account so as to consolidate the total assets of the retiring partner. Next is determination of the total amount due to the retiring partner. And this is important in order to know the total amount that the retiring partner can withdraw from the partnership. Settlement of the total amount due to the retiring partner then takes place. Previously, I have explained that this settlement may be done from the remaining partner's personal assets or from the partnership's assets. Lastly, the capital account of the remaining partners need to be adjusted so that the continuing partners determine their opening capital balances. After retirement of a partner, the partnership is like reconstituted, and therefore the remaining partners start from that particular point. That is why it is important to determine their capital balances after determining the profit sharing ratio. The following example will be used to illustrate the concepts that we have talked about.
Moses, Nancy, and James have capital balances of 2.5 million, 1.5 million, and 1 million respectively. When James decided to retire from the partnership, Moses and Nancy agreed to buy out James' interest by paying James 800,000 shillings each in exchange for 1/2 of James' total interest of 1 million required. The entry to record withdrawal of James from the partnership. This first example provides a simple illustration that can enable a student to understand the concept of retirement of a partner and the entries that are required upon retirement of a partner. Right. Let us first understand that in this situation, the partner who is retiring has an interest in the partnership of 1 million. But then upon retirement of the partner, the other partners have decided to compensate the retiring partner a total of 1.6 million. That is a total of 1.6 million, which comes from Moses and Nancy respectively at 800,000 each. Why are they compensating 1.6 million in exchange for 1 million? The difference between the two figures is known as a bonus. And they recognize that the retiring partner has accumulated some other value in the business, which is more than just the capital balance that the partner has in the business. Therefore, a difference of 600,000 is a bonus being given to the retiring partner in exchange of the value which he has created other than the physical assets and the capital that he contributed. That value is known as goodwill. But in this example, let us simply consider it a bonus and treat it as that bonus, because we are not going to do any calculation about it or do any entry about it in the books of the business. Again, you understand that we say that there are two situations. First situation is where the partners compensate the retiring partner out of their own assets. And this is a classic example of such a situation, that these partners have agreed to compensate the retiring partner outside the business with their own assets, without using the assets of the partnership. And we said in this case, the transaction is between the partners themselves. Therefore, the partnership is not involved in terms of contributing assets. Because of that, the accounts of the partnership will not be touched by this transaction in terms of the compensation, which is 800,000. However, the capital which is in the business of the partner will be accounted for as the partner leaves. So that capital will then be distributed to the existing partners or the remaining partners who have accepted to compensate the retiring partner. The first thing that we are going to do now that this is a very simple example is to prepare journal entries, which will show this transaction, of retirement of James. Now, upon retirement of James, their capital account of James will be debited. Therefore, James' capital account is debited. It's debited by 1 million shillings. And then this capital is distributed to the remaining partners equally because it is 1/2 for each partner, according to the example, as you can see. So each partner gets 1/2, which is 1/2 of the capital. Therefore, Moses will be credited, or Moses' capital account is credited 500,000 shillings. And Nancy's capital account is credited 500,000. Now you realize that we have recorded 500,000 and not 800,000 because 800,000 is considered to be a transaction between the partners themselves and not involving the partnership. That is why the difference of 600,000 or 800 or 300,000 each per partner is not brought in the books. The narration for this is to record retirement of James from the partnership. To record retirement of James. The total will be 1 million each. Right. Then the transaction need to be recorded, therefore, in the partner's capital account. The balance brought down in the account of James was 1 million. That is the balance of capital. The balance brought down in the account of Moses, 2.5 million. The balance brought down in the account of Nancy is 1.5 million. Then upon retirement of James, we transfer whatever we have identified in the journals. The first one is that the account of James will be debited by Moses, 500,000, Moses' capital account, and Nancy's capital account, $500,000. That therefore closes the capital account of James. Now that James has retired from the partnership, therefore there's no balance because the total of 1 million has been compensated. For the remaining partners, do double entry. The capital of Moses is increasing by James' capital at 500,000. And the capital of Nancy is also increasing by James' capital, 500,000 shillings. That therefore means the balance carried down for Moses will be 3 million. $3 million. The balance carried down for Nancy is now 2 million. That is the capital balance of the partners who are remaining. 2 million for Nancy and 3 million for Moses. Right, you can see this is a very simple example. It is introducing us to this concept of recording the retirement of a partner in the books of the partnership. Thank you. What the next example, which is more explanatory and more comprehensive. This is the second example to illustrate retirement of a partner from partnership business. Marcy, Edward, and Sharon were partners sharing profits and losses equally. On 31st December 2020, Sharon left the partnership. The other two partners agreed to share profits and losses equally. The goodwill was valued at 10 million. Sharon received cash from the partnership for the amount due to her on 31st December 2020. The statement of financial position before Sharon's retirement is as follows. In the statement of financial position, goodwill is 1 million, other assets 41 million. The capital account balances of Marcy, Edward, and Sharon were 14 million each. Required, prepare the partner's capital accounts and statement of financial position immediately after retirement of Sharon. There are two approaches to the answer of this question. First is a situation where goodwill is maintained in the books of accounts of the business. If goodwill is maintained in the books of account of the business, then goodwill account is prepared, and then goodwill is entered in the goodwill account. And at the end of the period, goodwill is carried to the next accounting period by having a balance carried down. In this case, goodwill is shown in the statement of financial position. Now, to begin with, we record goodwill of the business. At the beginning, there is balance brought down of goodwill, which is a debit balance, is 1 million. That is a balance brought down of goodwill of 1 million. But at the time of retirement of Sharon, goodwill is revalued at 10 million. That means the value of goodwill has increased from 1 million to 10 million, an increase of 9 million. If the increase is 9 million, this increase is shared among the partners, the old partners before retirement of Sharon, in their old profit sharing ratio. And before retirement of Sharon, the partners were sharing profits and losses equally. Therefore, goodwill will be shared among the three partners equally. That means 3 million each partner. Therefore, in Marcy's capital account, in Marcy's capital account, 3 million will be credited. In Edward's capital account, also 3 million will be credited. And then in Sharon's capital account, also 3 million will be credited. Then let us go to the partner's capital account and do the double entry of that transaction. The partner's capital account, the balance brought down of capital of the partners equal to 14 million each for each partner. And then we record the goodwill increase in goodwill, which is from goodwill account. Increase in goodwill is 3 million each. Then Sharon retired from the business, and after retirement of Sharon, Sharon was paid in cash, the amount that is owed to her on 31st December 2020. Now, to settle Sharon's balance, we have cash of the total that is owed to Sharon. The total that is owed to Sharon we can get here by determining the total for this column, which is 17 million. Therefore, Sharon will withdraw 17 million from the partnership in terms of cash. That is a debit entry. After that, we can now balance off the accounts, the two accounts, starting with the partner's capital account. And in the partner's capital account, we have the balance carried down for the remaining partners. Because Sharon has already retired, therefore we record the balances for the remaining partners, which is 17 million. As you can see, 17 million. If you add 14 million and 3 million, we get 17 million. The balance of Mercy is 17 million. The balance for Edward is 17 million. There is no balance for Sharon because Sharon has already retired, and the total for each column is 17 million. Right. Because goodwill is maintained in the books of accounts, we shall also have the balance carried down for goodwill, which is equal to 10 million. That is the balance carried down for goodwill is an amount of 10 million. Right, and that is the 10 million that was revalued here. Remember in the question we were told that goodwill was revalued at 10 million, and you can see that 10 million there. After determining the entries, or after preparing the entries to record retirement of Sharon, then we can now record or prepare the statement of financial position just after retirement of Sharon. And how do we do that? Start with goodwill. Goodwill is maintained in the books, and goodwill has a balance of 10 million. So we start with that as the non-current assets. The first non-current asset is goodwill, 10 million. That is followed by other assets. And the other assets in the statement of financial position before retirement of Sharon, the other assets are a total of 41 million. Before retirement of Sharon, the other assets are a total of 41 million. As you can see here, the other assets are 41 million. So we have that 41 million. But then upon retirement of Sharon, Sharon was paid 17 million as cash. Therefore, we deduct the 17 million cash that Sharon was paid to remain 24 million. The total assets, therefore, is 34 million. This is financed by capital accounts of the partners. And this capital account is only for the remaining partners. Therefore, we have Mercy. The capital account for Mercy equal to 17 million. And the capital account for Edward is 17 million. The total is 34 million, which is equal to the value of the assets. In this case, we have maintained goodwill in the account, and therefore goodwill is shown in the statement of financial position. That is how to record retirement of a partner where goodwill has been revalued and goodwill is supposed to be maintained in the books of accounts. The second approach to the answer of this question is a situation where goodwill account is not maintained in the books of the partnership. In this case, therefore, there may be no need to record anything in the goodwill account. In other words, goodwill can be recorded directly in the partner's capital account, or goodwill account can be prepared but then written off afterwards. I'm going to take an approach where there is no goodwill account prepared at all. Therefore, we prepare the partner's capital account and statement of financial position as required. Let us begin with the balances in the partner's capital account. Balance brought down for all the partners or for each partner is 14 million. Then for goodwill, at the beginning of the period, goodwill was 1 million. Then at the end of the accounting period, goodwill was 10 million. That therefore means at the beginning of the period, just before retirement of Sharon, goodwill was valued at 1 million. But then at the time of retirement of Sharon, goodwill was revalued to 10 million. That means there was increase in the value of goodwill of 9 million. That increase in the value of goodwill of 9 million is supposed to be shared among the existing partners in their own profit sharing ratio. The partners were sharing profits and losses equally. Therefore, goodwill of 9 million being shared among them will give each of them 3 million each. We therefore record 3 million as goodwill for each partner. After recording that, Sharon is retiring. Therefore, Sharon was settled with cash on 31st December 2020. That therefore means we record for cash which Sharon was paid, and the cash which Sharon was paid is a total of whatever the partnership owes Sharon. Therefore, that is 17 million. That is 17 million, and the total of Sharon is 17 million, as you can see. After that, balance off the account of the other partners, the remaining partners, by having a balance. Sorry, before after that, record writing off of goodwill, because goodwill is not being maintained in the account. Therefore, goodwill is supposed to be written off. To write off goodwill, the total goodwill of the company is distributed to the two partners and written off in the account, the two remaining partners, that is Mercy and Edward. In this case, therefore, we have goodwill written off. And goodwill written off in this case is the total amount of goodwill. The total amount of goodwill need to be written off, and that amount is 10 million. Therefore, we have 10 million being shared among the remaining partners, between the remaining partners, and the remaining partners are sharing profits and losses equally. That means 10 million is shared equally between Mercy and Edward, and that is 5 million each. After sharing goodwill among the remaining partners, then we have balance carried down, balance of the account of the remaining partners. Balance carried forward or balance carried down. That balance carried forward for Mercy will be 17 million minus 5 million, and that is 12 million. So that the total here is 17 million. For Edward, we have 17 million minus 5 million is 12 million. And the total is 17 million. There is no balance for Sharon, and there is no share of goodwill for Sharon. Having prepared this, we can now prepare the statement of financial position. In the statement of financial position, in this case, we will not have any goodwill entered because goodwill has been written off. We therefore start with other assets. And the other assets before retirement of Sharon were equal to 41 million. Therefore, we have 41 million minus the cash that Sharon has withdrawn from the business, so that we have 24 million. That is the total assets, which is financed by capital accounts for the remaining partners. So the capital account of Mercy and capital account for Edward, which are 12,000 each. That is a balance carried down. The balance carried down at the end or after admission of Sharon is 12 million for Mercy and 12 million for Edward. The total is 24 million, just like the total value of the assets. Thank you for watching. Please be sure to watch other videos in my channel.